6.2%. Do we believe it?
We absolutely do not believe this. I think that the key for this is that China's GDP data is never accurate. There's a lot of reasons, but it's not always political manipulation. A lot of us simply lag. And when the Chinese don't see, sometimes it takes a long time to collect the data, but when the Chinese see a particularly problem period in the economy, like the fourth quarter 2018, they don't want to show that the growth indicators have fallen off a cliff. So they smooth it out. They spread the weakness to later. A lot of what you're seeing right now is being reported is weakness that we saw earlier in the year, is what we saw fourth quarter 2018. We're seeing much better metrics in our own data.
How much better do things appear? And sort of what gauges do you look at? Because we were waking up this morning and you were seeing positive signs of retail sales or factory output or investment. What other data indicators can you look to give you a better idea of what's going on if you can't trust GDP, for example?
Sure. Well, China Beige Book collects from over 3,300 firms, so it's a very big database nationally. But within that, we track manufacturing and services and retail. Manufacturing and retail are outperforming right now. Services has a bump. Property's doing fine. So the major sectors are actually doing better than is being reported right now, or the new reports are reflecting what's happening better than the ones of a few weeks ago. But separately, you look at the credit. And when you look at some of the official credit indicators, it takes a long time for certain developments to actually filter into the government data. We've showed an extremely active credit environment for all of 2019. And so there's a lot more credit going out. So it shouldn't surprise people that there's more growth that's going to come from it, because the Chinese are much more aggressive right now than I think people think.
What do you make of the retail sales data, though, which seemed to suggest there was a little bit of a positive trend line, though I guess some people were kind of discounting it because it was all car sales or something?
Yeah, no, I think that's right. I mean, when we look at our retail for the second quarter, it actually was a lot better than even we thought it was going to be. Manufacturing was better than we thought it would be. Services, again, down. But, the retail sales in June, it's very interesting. The lowest growth in multiple decades gets the headline. But if you looked at what the June numbers were, even through official data, you saw a bump in industrial output, you saw a bump in retail sales, you saw a bump in fixed asset investment. Things are looking a little bit better. That doesn't mean things are great. Doesn't mean that there's not pressure from the trade side. But it does mean that this entire narrative that's being read off the headlines is just overly confusing.
And that's why we managed to see a rise in certain Asian stock market trading. We saw a reprieve, a fact that they were willing to look at the newer data. Why are things getting better? Can we thank the central bank for that? Can we thank the Chinese government for that?
Well, part of it is that the trade war is in sort of a stalemate right now. So the Chinese prepared their economy back starting in fourth quarter 2018, when the data were very bad, to try to deal with a nightmare scenario. So if President Trump went all 25% on all 500 plus billion, they wanted to be able to cushion the blow. That's not happening right now. It doesn't look like it's going to happen anytime soon, so that the credit support they put in the economy is more than they need. And as a result, it'll continue to cushion and sort of push up what they probably should be doing in a neutral economy.
So is the worst behind us? And if so, does that then mean the U.S. has more to lose in the trade fight than China does if they've already bottomed out?
I wouldn't say the worst behind us. When we're looking at 2019, I think that people have bit too much into this falling off a cliff narrative. But here's the problem. Every time the Chinese do what they're doing right now, they're kicking the can down the road. It means they're putting a lot of their credit into riskier and riskier borrowers. They're getting a worse return on investment. That means growth is going to slow more in the future. So they're creating major obstacles to be able to fix this next year and the year after. So, we have a long, slowing trajectory going forward. There's no question about that. But in the short term, it's, you shouldn't believe this beautiful line that just sort of dips every quarter in GDP.
You talk about the credit that they're sort of pumping in there to kind of boost the economy. But I saw some data, I believe it was from UBS and JP Morgan, where they talked about how a lot of that credit is going more towards land projects rather than something like infrastructure, which in theory would have more of a multiplier effect on the economy. Do you think that the money that they're pumping into the economy right now is being utilized in the right way to sort of sustain growth?
Well, it's a tough question. I mean, look, UBS and JP Morgan don't run multi-thousand firm surveys tracking what corporates are doing right now. Now, one of the things that concerned us in our data is that even though the top line results for second quarter looked better, unlike the first quarter, you didn't see investment jump. So first quarter recovery, top line results look better, investment jumps. Everyone was a little bit more optimistic from coming from a bad period in the fourth quarter. Second quarter, you didn't see that. Firms are still cautious right now. They see the trade war. They see central banks. And so this is a very cautious period right now. That said, things are a little bit better than people think.
Taylor, earlier today, you were showing the companies in the US that we should be looking out for in earnings season, they've really been in the middle of this trade war. Does this actually all sort of seem that actually some of the numbers might not be as bad as we expect for the likes of Ford, etc.?
You know, it was interesting because as we were talking to strategists, a lot of them said that the resolution of the G20 didn't come soon enough. So a lot of the bad numbers will still be baked into 2Q because we got a resolution near the end of it. So there wasn't enough of a boost to recover from that. As you can see there, Micron, Intel, some of the chip makers, of course, with the most exposure. And then you get the bellwether companies like a Boeing or a Caterpillar that's on the industrial side. Interestingly enough, Gina Martin Adams was writing a strategy note that outside the financials, it will be industrials, that they're getting lower revisions, but they actually might continue to do well. And second half of the year could be shaky, but it might be okay if we can get through it, basically. So it looks like second quarter would be bad, but there would be a pickup in the third quarter. So I guess my question to you is, as we sort of kick off earnings here and take a look at sort of the effect of China on some of these companies, is the second half sort of going to be the bottom out as it relates to the trade effect on some of the companies like we saw there with the Micron or an Intel, so to speak?
I think unless you see a major step up in the trade war, so the president changes around and he goes harder at China, and that's not what anyone thinks is going to happen right now. I think that there's a lot of credit provision in the economy that people don't understand, and we're not looking for this fall off in growth. I think if you read the average investor note in Wall Street, any signs of good news or a blip, I don't think that's right. I think you're seeing a lot more strength in our data than you are in official data right now, and that's because it hasn't flown through. So when official data catches up with our data, I think you may see some upside surprises later in the year.